We're going to move from the preparation of the cash flow statement, the operations section, using the direct method, to looking at the other two portions of the statement of cash flow below, which is cash from investing and cash flows from financing. And hopefully, as it says, you will remember that the presentation, this does not change regardless of whether you're using the direct or the indirect method. So this isn't something that you need to worry about. But just as a recap here, we've got cash from operations of $70,000. We had cash outflow for investing purposes of $240 and financing inflows of $60 for a total decrease in cash of $110,000. Now, hopefully you will remember in the last video when we started looking at the statements and I said, remember this decrease in cash. This will be important to know whether or not this will help us know whether or not our statement of cash flows sort of is proven to be true. And what we can see here, and I won't go back to that balance sheet, but it was a decrease in cash of $110,000. As you saw in our first video, we had an increase in cash of $70,000 from operations, again a decrease from investing of $240, an increase in financing of $60 to get us to that overall decrease in cash of $110,000, as is reflected on the comparative year between year one and year two balance sheets for our cash. So this is the bottom portion of our statement of cash flows, financing activities, and so we've got the net decrease in cash. We have our year one, well, I should say our year two beginning balance. It's also our year one ending balance of our cash of $200,000. Our year two ending balance cash of $90,000. And so this change in cash, this net decrease, is how we get from our beginning cash balance at the beginning of the year to the ending cash balance at the end of the year. And so if this net increase or decrease in cash after you've computed all three sections of your statement of cash flows does not match your decrease or increase in cash from the beginning to the end of the year, or the end of one year to the end of the next year, you've made a mistake someplace and you've got to go back. So this is a good checksum figure. And as your slide says, okay, what about more complex companies? And so I am glad you asked. We're now going to look at this from a more complicated standpoint, where we have changes in current assets and liabilities, which we did not have with our simplex example. So we will also be looking at depreciation expense, gains and losses, and long-term sale of assets, and receivables payables related to more items than we had looked at in our simple example. We have our cash and government notes, which is treated as cash equivalents. And so we can see that overall between our cash and cash equivalents is a decrease of $3,420. And again, this is the target number that we need to get to at the end of our financial statement, right before we get to sort of our bottom line. What is our current cash position today? And so hopefully we will do it the right way. We had beginning cash at, or ending cash at the end of year one, ending cash at the end of year two, and again this total is $3,420 in decrease. We set up our statement just like we did on the simplex example, and now we're going to make those calculations. So hopefully you remember that we're going to start looking at this from our sales figure. We have deductions of $8,705, and so we're not going to go through the T accounts for these examples, but hopefully you will remember that what we're looking at here is our accounts receivable. And we're looking at our accounts receivable increased by sales, decreased by payments from customers, and getting us to the ending amount. And here we have a deduction of $451,395. Now, what is that deduction? That's not a deduction in our accounts receivable. That is a deduction in our cash position as a result of payments made or not made by our customers. So what your balance sheet should show is that your accounts receivable actually went up by $8,705 that year to get to this calculation. And if our accounts receivable went up, that means we didn't collect as much cash from our customers because they're still owing this. Oops, let me go backwards. And if we look here at our comparative balance sheet between year 1 and year 2, we see that that's true. We had year 1, we ended with $51,510. Year 2 ended with $60,215. So fewer people paid us, which impacted our cash and caused our cash to go down by $8,705. So we're going to take that off of our net sales to get to our cash flow for sales. We're going to then look at both merchandise purchases or merchandise inventory account, again with purchases and cost of goods sold. We're also going to then combine that with our accounts payable and determine our either cash increase, decrease as a result of cost of goods sold. And so that tells us that we have an overall increase of $279,570. We total this up here, and so we've got some more things that happened here in addition to what occurred last time, which was basically we looked at our change as a result of payments from customers as well as inventory sales and changes as a result of cost of goods sold. Now we've got some changes as a result of our operating expenses. We've got supplies and prepayments that changed. It went up by what is that, $1,250. And so now we need to figure out what combination of purchases and use gets us to our ending balance of $4,000. So obviously we bought more than we used, and if we bought more, then we must have less cash as a result of having bought more stuff. So this, again, this $1,250 increase indicates that more was purchased than was used up. So we've got this $1,250 here at our operating expenses. Depreciation is also something that we need to take into consideration. And so we've got $10,400 is in our operating expenses. Again, this is a non-cash item, so we will have taken this into account when we obtained our net income figure. But because this doesn't affect cash, we've got to fold that back in. And so we've got $10,400. I guess we have more before I keep going with slides. We've now got liabilities that we now have to deal with. And we've got accrued and withheld payroll taxes. Again, same analysis that we've done with the other T accounts. we look at what we started the period with, what we ended the period with, and know that some combination of having increases or decreases in these accounts will result in our ending balance. So we know that we have a $570 decrease. We're not going to walk step by step how we achieve that decrease. Hopefully you kind of get the idea by now, but it suffices to know that this is going to go here. So you're thinking to yourself, okay, this decrease, how come this decrease is showing up here as an addition? So maybe just remembering kind of a rule of thumb. So what we were looking at just now is a liability. And if a liability decreases, we're going to give it the opposite treatment here, and we're going to treat it as an addition. So let's take a step back for a second and look at what we have done at this point. We took, here we've got on the left, in the leftmost column here, our income statement, which was prepared on an accrual basis. We have made some adjustments, and we have recomputed that. And what we essentially have here on the right is a cash basis income statement. And so we now have, and again, just to recap, we have net sales minus cost of goods sold gets us to gross profit. We subtract operating expenses, and this is our cash basis operating income. Now we continue on, and now we look at accrued interest receivable. We see that that has gone down, and as your slide says, more interest, the decrease indicates that we received more interest during that month. And so if we received more interest, our cash position must have improved. So we're going to add that $200 back in. Now let's take a look at this gain on sale of equipment. We're subtracting that out of here. Why is this? It's because this does not belong, what we're doing right now, what we're preparing is the operating portion of your statement of cash flows. It doesn't belong here. So we're going to subtract it out because we're, again, what we're trying to do is convert your income statement into your statement of cash flows. And right now we're in the operating section, and gain on sale of equipment does not get included in here. We're now going to move down to this interest expense. And in order to figure out what to do with this, we need to analyze our interest payable account. Hopefully you're thinking payable, liability. Okay, how am I going to treat a liability if it goes up or down? Hopefully that's kind of the analysis that you're starting to undertake at this point. What we see here is that we started with 80, we ended with 100, so we know that our liability went up. And the way that we treat the increase of a liability on this statement of cash flows is that we will subtract it. It will be a deduction from our statement of cash flows. So, and if you think about it, so this interest expense that we got credit for, we really didn't pay all of it. So we've got to take this out of the analysis and get it back down to what we actually paid, which would have been $630. We're now moving on to income tax payable. Again, think liability. What happened? Well, it went up. We owe more in taxes now than we did at the end of as a result of what we did during the year, and our liability went up. So that's going to be a deduction here. Oh, and I should move me. Okay. So we went from 24,000 down to 23,000. This gets us from our accrual-based net income of 47,755 to a cash basis net income of 36,380. And so now we've done the calculations. We're going to take this final column here and we are going to turn it into an actual financial statement of cash flows. And Here we go. So as I said, we just took the numbers from that last column here and we plugged it into the format that we use for the direct method. And from there, we would then go to, once we get to our operating activities, we then move to investing and financing activities. So this is just cash by operating activities. So now to that, we're going to add our investing section below where we look at cash impact of investing activities. Purchases, sale of equipment is what we had here. We have our net cash by investing activities, which went down by $18,200. As a result, mostly of the stuff that we bought, we did sell a little bit, but we bought more than we sold. And then this is what represents the bottom of the statement of cash flows. They just didn't jam it all onto one slide for you, but this is our financing activity, which appears after the investing section, and it shows us here that we had a net decrease in cash from our financing activities. And now what you see here, this negative 3,420, not only is that our net increase and decrease in cash, and where that comes from is we sum up cash used by investing, or I should say financing here, and then investing here, and then operations here, and that's what gets us to that $3,420. Now, hopefully this number looks a little familiar to you, because hopefully you remember back at the beginning of this slide, I said, please pay attention to this cash equivalents decrease number of $3,420. This is how you're going to prove that all we've done when we've prepared this statement is actually correct. And lo and behold, it is. So when we look at the comparison of the year one, year two balance sheets and the changes in cash and cash equivalents between those 2 years, we saw that our cash went down by $3,420, and lo and behold, we have now proven that to be true. So to finish off our financial statement, our statement of cash flows is just a couple more steps. We then add in our beginning balance cash, and that gets us to the cash at the end of this accounting period, which again should also match the ending cash balance on your balance sheet. Also, I should say cash and cash equivalents balance. And just one more small step in the process. We need to also report significant non-cash investing and financing activities. So we included here that delivery equipment by issuing a 3-year note. This is something that isn't going to be calculated in here. It is a disclosure that we are making at the bottom of our statement of cash flows. And as a result of having made this disclosure here, we don't need any separate disclosures, supplementary disclosures for the statement of cash flows using the direct method, because everything that investors or lenders would need to know is contained on the face of the statement of cash flows prepared under the direct method. And that concludes statement of cash flows prepared using the direct method.